Thanks for joining us for the Member xCite presentation. The Member xCite presentation is informative, interesting to the audience, and showcases the strengths of the presenter as an entrepreneur and their area of expertise. It's not a sales pitch, it's a 10-minute educational and insightful exploration into what they do. And of course, it's exciting.
Ladies and gentlemen, please welcome our xCite presenter today,
Matt Sloane from Matthew Sloane Loan Market, to present to us on why the mortgage broking industry is now writing 7 out of 10 loans in Australia. Over the last few years, the mortgage broking industry has been under fire and scrutinised by the government and industry bodies, and yet come out stronger and now dominating the market. How has the industry used leadership to rise above the scrutiny and thrive? For those of you who don't know Matt is a broker, husband to Caroline and dad to Ryder and Braxton. On holidays, you will often find them camping and exploring the southeast. Matt coaches both boys soccer teams at Holland Park Hawks. Matt is community-focused and an example of giving back to the community sponsors Holland Park Hawks as well. Matt is an avid F45er and is focused on keeping up with his 2 boys as they grow.
ladies and gentlemen, please put your hands together for
Matt Sloane.
Brokers across the country, we're writing just about 7 out of 10 home loans now. So, and to further Kel's point there, the industry has been under scrutiny for a few years, heavy scrutiny. So we've had an ASIC review a few years ago. So at that time, I think that was about 2016, mortgage brokers are writing about 50% of home loans in the country. More recently, and probably more famously, we've gone through the Royal Commission. So our income's been scrutinised. Everything we do basically has been scrutinised. So what that's done is I think our industry's come out on the other side and come out stronger. And I'm just going to go through why that is pretty quickly. So I think one of the main reasons the industry's come out that well is that's forced the industry to really become really good at conveying and lobbying to the government, the politicians, what exactly it is that the mortgage broking industry does, how we do it, and most importantly, how the Australian consumers are better off. So these reviews, I think, so they back the industry almost back the industry into a corner and forced the industry to really demonstrate the value proposition that the mortgage broking industry offers. In turn, that's flowed through to the consumer, I think. So at the time of the Royal Commission, which is 2019-20, that financial year, less than 1% of complaints to AFCA, who's the industry governing, the Australian Financial Complaints Authority, one of the industry governing bodies, the complaints were less than 1%, but we still went through what we went through the Royal Commission, ASIC reviews, ask any broker. It was a time of a long time too of uncertainty. However, you know, at the time of the Royal Commission, the mortgage broking industry was writing up to 60% of home loans. So further in the cap to the industry, we've recently tipped over 70%, and we're recently due. One of the recommendations for the Royal Commission was another review in June this year, because of all the lobbying and well, obviously the good work that the industry has been doing for years. If the government decided that review is no longer required, so that's a feather in the cap for the industry. So I think that's a massive win for the industry and obviously for the consumers. So a little bit about what's changed with the Royal Commission. The big thing was that as of January 1, 2021, mortgage brokers have been, the legislation's changed. We now work under best interest duty. So what that is in general is we have to work in our clients' best interests. Previously to that, the legislation changed. We had to write a loan that was not unsuitable to the client. So a lot of people that have used a broker before sort of suggested there was no difference. This is what mortgage brokers have always done. And I think that's reflected in the well, obviously consumer sentiment. It's definitely reflected in statistics over the last few years. Mortgage brokers have been quite strong in terms of compliance and customer satisfaction, without a doubt. So with best interest duty, there's a little bit more paperwork, a little bit more compliance, but I firmly believe it's what mortgage brokers have always done. It's just now got to be, I guess, documented more. For a lot of people, that for most brokers, it was already done anyway. So I guess what it is that mortgage brokers do, I guess that banks don't, is we go through a really good qualifying criteria with our clients. So we assess someone's situation, really look at their goals and match the best lender to their situation. So one of I guess the general criteria we look at, and sorry for the ladies that are mortgage brokers, you've probably heard this many times before, but what we look at is really the five, what we call the 5 C's of credit. I'm going to really brush over this because we could sit here all day and go for it. So the 5 C's of credit, we've got character, capacity, capital, collateral, and conditions. So capacity is someone's borrowing power. So that's very different. That changes from every individual's situation is different, and every bank's qualifications are different as well. So so it differs with each lender. There's many factors that contribute to that. Income is obviously one, debts, HECS debts, living expenses, how stable your income is, for example, all these things factor in. So the next one, character. So a lender or a bank, they want to know if a borrower is trustworthy. And one way they look at this is look at someone's credit history. So if you pay your debts on time, generally they'll consider you fairly trustworthy. But on the other hand, if you're paying everything late, and that reflects on your credit file, the bank's going to deem you, well, closer, I wouldn't say not trustworthy, but they're going to really frown upon that. So the next one, capital. So that's a lender will look at your assets and liabilities. For example, how much savings you have. The higher the savings, obviously the better it looks. Whereas on the other hand, for example, a lot of credit card debt, buy now, pay later, sort of afterpay facilities. The more of those facilities that you have, the worse it looks. Next one, collateral. So that refers to the property being used as security. So the property being purchased or refinanced, for example. So the lender will look at the loan amount against the property. This is commonly known as your LVR, or your loan to value ratio. So this is important because if the bank has to foreclose or recoup the loss, the higher the LVR, the riskier it is for the lender. And that varies with property types, with sizes of properties, locations of properties. So how comfortable, I guess, a lender is with a property does often depend on a postcode even. So the variations here, they're pretty much endless. And of course, each lender has different appetites, and definitely it's not a one rule fits all. Another thing they look at is conditions. The fifth C of lending, that's more or less everything else about your situation. Like, for example, if someone's pregnant, the situation's going to change. Is someone a permanent resident, or are they living overseas? Is the industry you're working in stable? A recent example of that is during COVID. If you were working in hospitality, it was almost impossible to get not impossible, but it was pretty tough to get a loan because a lot of lenders shut shop in that respect. So the lenders do work on risk. They use algorithms to determine the riskiness of your application. So that's known as credit scoring, which is different to your credit score you get on Equifax or Ilion. So, which they're considered also. So all lenders have different risk appetites, and they have these different algorithms. And it's the way they look at, or the way they interpret the 5 C's of credit. So things like they look at income differently. They look at different risk appetites in terms of LVRs, loan to value ratios. So some lenders will lend up to 95% of the value of the property or higher. Some lenders will want a bigger deposit. Some lenders have a minimum credit score that they want to look at. Other examples, for example, debt to income ratios, which is probably more one of the recent interpretations. So it's common. So debt to income ratio is someone's debt. So it's a percentage of their income versus their debts. So if someone's annual income is more than 6 times, if their debt's more than 6 times their annual income, sorry, look at that, that's a bit of a tongue twister. If their debt's more than 6 times their annual income, then even if the rest of the criteria is ticked off, that's going to be a no to a lot of lenders, not all of them. Obviously, like everything else, there's different rules and different qualifications for every bank, and that will change in certain circumstances. Postcodes, all lenders have different postcode restrictions. Most major cities are okay, but for example, mining towns, there'd be restrictions in certain places like that. Self-employed clients. So most of us, or all of us, are self-employed. Some lenders will want to see 2 years tax returns and financials. Other lenders will look at less. They'll look at the most recent 12 months tax returns and financials. More recently, some lenders will look at, if say you've got a mum and dad with a company, if they distribute themselves a wage, we can use the wage in isolation in certain circumstances. That would be in a situation where a company is running profitably and we can show that. It's just a more simpler verification for self-employed people. Look, so this is just scratching the surface. One of the other main reasons I think mortgage brokers are writing 7 out of 10 loans at the moment is networks in places like BX. It's because most mortgage brokers, we have access to a good accountant, a good financial planner, a good real estate agent, insurance broker, family lawyer, for example. So it's having that network of trusted advisors as well that we can support our clients with too. So if you walk into a branch, they're going to, well, there's this, gone of their days almost, where they'll send you to their financial planning teams. A lot of banks have sold off their financial planning firms. Just Google it and you'll see you'll find out why. But that's, I think, in summary, look, it's a story of choice, advocacy for the consumer, resilience, passion, and persistence that the industry, I think, has triumphed and definitely turned what was a massive obstacle into a massive win. And that's why mortgage brokers write 7 out of 10 loans.
Beautiful. Thank you very much, Matt. So just, has anybody got any questions for Matt around that? Just if you want to wave your hand or push the little button up there.
Yes, I have a question.
Go
Thank you,
for
Matt.
it.
I really enjoyed that. How tough is it nowadays to get low doc loans?
It's a tough. It's probably, I think the terminology low doc is probably almost light doc is probably a better terminology. There's still lenders out there. I've just settled one a couple of days ago, where a lot of lenders now looking at, depending on someone's situation. So it's if we can, that client had 2 BAS statements that we utilize. There's 3 ways. So you can look at BAS statements, business bank statements for 6 to 12 months, or an accountant's declaration. So there's 3 forms. Some lenders will want 1 of the 3, and a couple of lenders will want 2 of the 3. Depends on what can be produced. Loan to value ratios. So, or I guess reverse engineer that, you would need minimum 20 to 30% deposit as well. So if we can, obviously if we can tick those boxes, when I say, yeah, then it's can be considered.
Okay.
Okay, thank you.
Joshua, you got another
sense?
question, mate?
Yes.
Yes. So, thank you very much for the presentation, Matthew. I have a quick question. As you were saying, a lot of the banks have moved out of certain spaces. You mentioned for financial planning, but also I've noticed that they've also moved out of the self-managed super fund loan space as well.
Yes.
So, are there many lenders that you know of that they still offer that product?
Yeah. So, and that's so. Definitely, Joshua. Part of the reason I joined Loan Market 8 months ago, and one of the reasons I joined was the lending panel. So we've got over 60 lenders, 44. I think 44 do residential finance, and I think there's about 6 or 7 lenders on our panel that'll do self-managed super fund, consider self-managed super funds.
Okay. Cool. Thanks for that. Vanessa.
Having tried to do a self-managed super fund purchase previously, I will never, ever bother with that again. A whole lot of money wasted and time wasted. But I went down a trust instead, which was much easier. My questions are two. Rental income. I notice that it doesn't appear, if I'm buying an investment property, that the rental income of that property is, particularly if it's going through the trust, is considered as part of the mortgage application.
Yeah, it should be. Vanessa, most lenders will use, once again, depends on the type of property, but commonly 80% of the rental income. That does differ with different situations. Sometimes I think one lender will use 90% in certain circumstances. If it's, say, a mining town or something like that, some lenders might restrict that to, say, 50%, but it's pretty standard to use. If it's if it's a property being purchased, what's commonly used is what's on the valuation. So the valuation will have a rental income amount.
Yeah.
And if we had, so that's generally what's used in an application.
Okay, because I think I've hit the limit on what I could have as mortgage. So investment properties really now would be sustainable on rental income and, just a bit of other. The other thing I'm interested in is, for a long time now, I believe banks have been hiding the defaults that are happening, and now with interest rates going up and up and up, and probably up a few more percentage points, how do you think defaulting and the market is going to play out over the next 12 months with increased interest rates and inflation pressures?
So one of the things that we have to do is, up until when best interest duty came in, up until recently, there's been a buffer in interest rates where every bank has to factor in. So it used to be 2.5%, and recently it's been increased to 3%. So if your loan is, say the interest rate you're getting on your loan is 3%, the bank's going to calculate that at 6%. So yeah, the increases in rates will impact families, but to a point that's been factored in already. It's for that reason, because the rates always been at the lowest they've ever been. They're always going to go up. Where they're going to go to, look, no, I don't think anybody knows, but a lot of that buffer has been factored in. Once it hits that, if it hits that 3%, there'll be a little bit of struggle, but there's other buffers built into the calculations too. There's living expenses buffers, rental income buffers, there's some income buffers in there as well. So what someone can borrow in reality is not the same as what you get on a bank calculator. A bank, your borrowing capacity through a lender should be, and rightly so, less than what you can. So the common thing that we hear is, say, for example, a first home buyer paying, say, $500 a week in rent, goes to get a loan from the bank. The repayments, call it $2,000 a month. The bank says no, and they say, well, hold on, I'm paying $500 a week. Why can't I get a loan? And that's why, because there's a lot of buffers built in there.